Did you know that the richest investor in the world, Warren Buffett, started out with just $114.75? He is now worth more than $80 billion. At the end of this video, I'm going to reveal to you how much his $114.75 would have been worth today if he had invested it in what he advises to most people now. So it's possible to start investing with little money. But where do you start? First of all, I'm going to give you some technical information on how you can literally get started. Then I'm going to give you the information on how to actually become successful at doing it, with the help of some tips of Warren Buffett, because who can you learn it from better than the richest investor in the world himself? Let's dive in. How you can actually start investing. Before you start investing, you need to either find a broker online, or you can do it via your bank if your bank allows it. A broker is an institution which buys and sells securities on the stock exchange on the behalf of its clients. In the old days, you would often have to go to or call your broker to make a transaction. Nowadays, most brokers have online platforms on which you can make a trade with just one click of a button. There are many brokers out there. I might go over a few I think are good in another video, but I'll give you some info on what to look for when you go looking for a broker yourself. Number 1. Check if your broker is regulated. When you choose a broker, it's wise to choose one that's either regulated in the UK, US, Australia, or other reliable regulated areas. Regulation is important because the regulators set the rules for brokers, and due to constant monitoring of business transactions, a regulated broker is required to keep sufficient funds to complete their clients' transactions. However, not every regulated broker is automatically a good broker. It's important to check where it's regulated. If a broker is regulated, you will often find it on their website, and you can check it online or on BrokerCheck, to which I will leave a link in the description of this video. Another factor to look for is at the minimum amount of money you have to put into your account to start with the broker. Some brokers require you to put thousands of dollars, some hundreds, and some even have no minimum at all. Because you have little money, your possibilities may be more limited. The third thing to look out for is leverage. Some brokers use leverage, which basically means you can invest more money than you have. Some brokers may offer a leverage from 1 to 20 on a certain stock, for example. That means if you invest $100, you actually invest $2,000. With leverage, you can lose more than you invest, but you could also make more money faster by small changes in the price. However, trading with leverage is advised against if you don't have at least $5,000 because of the risk-reward factors. Some of these brokers are also not suited for long-term investing, but for trading on a daily basis. This video will be more geared towards long-term investing, but I still wanted to let you know that this is an option when choosing your broker. Wise to compare a few brokers and see what kind of stocks they offer, because this is also different for every broker, and then choose one you feel comfortable with. It will vary from country to country on which brokers you can choose from, but all this information and more will be available on their website. Also contact your bank to see what possibilities they have when it comes to buying stocks. Now let's dive into the teachings from the richest investor in the world, Warren Buffett. Remember to educate yourself well and make your own decisions when starting to invest. I took some tips that are especially geared towards people with little money. Warren Buffett thinks that most people will be better off buying low-cost index funds instead of stocks. This is especially a good idea if you have little money, because the risk is widespread and the commissions are very low. An index fund consists out of multiple shares. The S&P 500, for example, stands for the 500 biggest companies in America. So you're buying shares in the 500 biggest companies in America. That means your investment will never go to zero and your risk is minimal when holding the long term. According to historical records, the average annual return since its beginning in 1926 through 2018 is approximately 10%. That means if you would invest $10,000 and just hold it for 50 years, assuming the 10% average doesn't change, you will have $1,173,909.53. That's without taking fees, taxes and dividends into account. Take note that this is an average, so it may go down next year and may go up 20% in another year. but it's a good indication that it's a reliable index fund for long-term hold. There are many of these types of funds available in the market, and they each consist of different types of stocks or even real estate. If you still want to buy individual stocks, you will have to gain some knowledge about the companies you're investing in. You will have to do a lot of work and learn a lot about how a company's value is made up, for example. This will greatly help you though, because it will enable you to identify cheap stocks, which Warren Buffett uses in his strategy as well. You will have to have an interest in a certain industry. Maybe that's tech, maybe it's food, maybe it's something entirely different. There's no one size fits all. Each industry has its own potential. Warren Buffett often tends to avoid stocks in industries that he doesn't know a lot about, like tech businesses. That doesn't mean he doesn't invest in them at all, but if you look at Berkshire Hathaway's, Warren Buffett's company, portfolio, you will see a pattern of the type of businesses he invests in. Because you have little money, your options are much more limited, so you'll probably have to focus on one specific industry. Warren Buffett says, invest in what you know. Now before you start putting money into any stock, make sure that you know exactly how much you're willing to risk. This is different for everyone, so you have to decide it for yourself. You want to invest for the long term, so you will also have to decide for yourself how much you want to put aside each month to put into your investment portfolio. It's no use to put $100 into a stock and wait for it to grow to millions. The chances of that happening are slim to none. The books I've read and people I've heard of say that putting aside 10% of your income each month and putting it into your investment portfolio is the least you can do if you want to get serious about investing. If you can't put aside 10% of your income every month, this forces you to re-evaluate your income and expenses as well. Put all your expenses and your income in a nice spreadsheet. Now do a simple calculation, income minus expenses. Then start looking at which expenses you can reduce or cut completely. It's quite simple but important. These are just some steps in getting started with little money, but I hope it will help you into getting started. The sooner you start, the better, because investing is a long-term game, and congratulations, you stick to the end. Now, as I promised, if Warren Buffett would have invested his $114.75 in the S&P 500 in 1942, it would have been worth $606,811 on the 31st of January 2019, pre-tax, no fees, and all of his dividends reinvested. He mentioned this in his annual letter this year in February. Thanks for watching. Give this video a thumbs up if you like it, subscribe to gain more knowledge about investing and other skills that might help you make money and in life in general. Bye bye.